In this video, I want to do a brief update on uranium, gold, and a couple sectors I find interesting right now. The first chart is Uranium Participation Corporation, which is a fund that attempts to track the price of uranium. What I like about recent price action in this chart is that this fund is attempting to find support at a former resistance level back in 2016 and is also attempting to retake the 30-week moving average after this pullback we've seen in the uranium sector over the last 2 months. So typically in bull markets, and especially in strong bull markets, price action likes to stay above the 30-week moving average. So we want to continue to see if this fund can get back above the 30-week moving average and stay above it. Now what's even more interesting is the action in the uranium miners. In the uranium mining ETF URA, you can see that the price action continues to stay above the 30-week moving average. And more importantly, it's actually continuing to outperform the price of uranium over the last few weeks. And this is interesting because typically in bull markets, companies that mine a commodity will outperform the underlying commodity when the market is strong, and vice versa when the market's weak. Commodity producers will dramatically underperform the underlying commodity. So to see uranium miners diverge from the spot price of uranium is a bullish sign. And you can see this more in depth in this chart, which compares the price of URA directly against the price of Uranium Participation Corporation. And one of the things that really, if you were paying attention to this market, what was a big divergence last year was how dramatically the uranium miners outperformed the spot price of uranium, even though they both fell last year. I think the spot price of uranium was down about 40% last year, but uranium miners were only down a few percent by the end of the year. And you can see that in this chart where the bottom was actually made back in early 2016. And once we made the final low, it was actually a higher low in this ratio. And you can see again in the price action is actually consolidating the recent pullback, showing that uranium miners continue to outperform spot uranium. So I see that as a bullish sign for this continued bull market in uranium. Turning to the gold market, I've been neutral and to bearish on gold since November of last year when gold broke down below the 30-week moving average. I didn't really expect a new bear market in gold given the fact that we were coming off a major bear market in gold that ended at the start of last year. But still, a breakdown in the price action signifies, either a stage 4 or continuation of a kind of a larger stage 1 base. And that's actually what we've seen in gold, is that after it finally kind of made a bottom late last year, it's still kind of been trying to retake the moving average, but continues to kind of fight through resistance. Now, overall, I think this correction has gone on long enough to shake people out of this market. It's been, going on 6 months now since it broke down, and that's definitely enough time to start a new uptrend. The question is, how long is it going to take gold to fight through resistance that was established back in November and back in October with a lot of selling in gold related investments? So I look at the 125 level on GLD as really a good line in the sand because it is overcoming the two big downward moves in gold that occurred in late 2016. And we're actually not too far away from that level. And we really haven't seen a pickup in volume in GLD yet, but there has been some decent volume in the gold mining ETFs. One of the main factors that will influence what happens with gold, whether it continues to just drift sideways or whether it can break into a new bull market, in the more near term is what happens with the US dollar. And we continue to see the US dollar just consolidate above the moving average, which is still trending higher. So there's no confirmed top or downtrend yet in the US dollar. And really, it's still kind of just consolidating, and it's left to be seen what's going to happen with this market. But I think whatever does happen is going to eventually cause gold to either break out or continue to move sideways in kind of a range bound market. And one other thing to note about the gold sector is I am seeing more gold stocks pop up in my research where I look for stocks breaking out on volume. And I haven't seen gold stocks popping up hardly at all over the last 6 months. So to start seeing them recently over the last couple weeks is a good sign for the gold sector. Now, two sectors that I think are interesting right now. One of them is the home builders, and you can see on this chart that the home building ETF XHB has been in a big consolidation for the last 4 years, and it's been underperforming the S&P 500 for the most part during that entire time, except for a small period in 2015. And what I really like about this chart is the tight price action over the last 6 months in this ETF, and again over the last couple weeks where the market's been under pressure, but the home builders have been acting quite strong and resilient, and that's typically what you see when a market takes over leadership in the overall stock market. So you can see that this ETF is really very close to breaking out of this basing pattern, and it's really not that far from its highs way back in 2013. So hasn't made a lot of progress for a number of years, but could easily break out of this consolidation and become a new market leader. One thing also to pay attention to is whether the ratio against the S&P 500 continues higher and starts a new uptrend. One stock in this sector that I find interesting is Pulte Group. I don't own this stock, but again, it's got this huge basing pattern and has tight price action over the last couple weeks, kind of a flag pattern, and you can see the volume picking up too in this stock. And notice how it's starting to outperform the S&P 500. Now, the other sector is the shipping sector, and the shipping ETF SEA is really not a good ETF for the dry bulk shippers because from what I can tell, this ETF mostly holds a lot of oil-related shipping stocks. But this is the only ETF really to look at for the shipping sector. So in general, the oil tankers, a lot of them are starting to break out like the dry bulk shippers, but I think the dry bulk shippers have better patterns in some cases. You can see again on this ETF that it formed a nice basing formation in 2016, a lot of tight price action, and then started breaking out on volume so far in 2017. And the shipping stocks have been in a massive bear market for a number of years. A lot of these stocks have a lot of debt, and you have to look at some of the financials of some of these stocks because some of these stocks are considerably risky. So definitely a sector to not. I would definitely would recommend doing some due diligence on whatever stocks you look at, and especially their financials before looking at just the charts in some of these stocks. But one stock that I own in this sector, full disclosure, is Safe Bulkers. This stock has been breaking out on massive volume in a new stage 2 advance over the last few weeks. And again, you can see the tight price action going back through 2016. And this stock is way off of its highs from a few years ago. Another stock in this sector is Starbolt Carriers. Again, you can see it breaking out on volume at the start of this year, and there's a lot of other stocks in this sector that look just like this, which is, you know, as far as stage analysis is concerned, this is exactly what it looks like. It's a stage 1 base and then a breakout on heavy volume and into a new advance. For more information on stage analysis, check out my website at nextbigtrade.com on the stage analysis page. One last thing to discuss is the emerging markets, because a lot of times when emerging markets are outperforming in the stock market, that's a bullish sign for the commodity sector. And we're seeing kind of just that, even though the markets have been weak over the last couple of weeks. Emerging markets are continuing to try to outperform the S&P 500, and if this continues, the emerging markets have been in a sideways grind for a large number of years, and if they do continue to outperform, I can see kind of a worldwide shift towards foreign stocks, which I think would be bullish for not just these foreign markets, but for commodities as well. So, and as always, nothing on this in any of my videos is a recommendation to buy or sell anything. Please see my disclaimer. And again, for more commentary and videos, check out my website at nextbigtrade.com.